All right, we've got just under 2 minutes until we are going to get this thing going. We are going off at a special time today, streaming at noon Eastern, so we can be done in time to watch the NFL games later today. So in about 90 seconds, we are going to get this thing kicked off. So for those of you who are sitting there patiently waiting, thank you so much, and we will get started soon. All right, that is the timer. It is time to get this thing started. Let me X out of the notification. And welcome back to another weekly stock market scan, option selling stream, whatever you want to call it. We were off last week quite literally because I lost my voice from yelling so much at the 49ers game last Saturday. So, maybe a little bit proactive getting this thing out of the way before the Niners game today so that I can clearly speak to you guys about what we're going to be doing for the upcoming week in the market. So for those of you who are in our Discord and have been following along a little bit, obviously it has not been a great year for us. No shame in admitting that, right? We are down a very, very decent amount of money so far in January. It is a huge sum of money that we're down right now. However, the belief remains the same that it's nothing we can't dig ourselves out of. It's good that this happened in the first month of the year because the good news is that we have 11 months after this to make that money back. And the good news is last week was our first green week so far in the market this year. And it wasn't huge, but we outperformed a little bit. Again, a lot of work to do, and a lot of the trades from last week are going to be similar to what we have for this upcoming week. So we're not going to spend too much time recapping what we did last week, but rather, try to provide some more value by focusing a little bit more on what we're doing for the upcoming week, because especially for those of you who have been in our Discord server and follow along with what we're doing on a day-to-day and week-to-week basis, you've probably heard a lot of these things already explained, into the ground a little bit, so we will spare you from having to listen to that. But, really quick, a $1,400 return last week, pretty solid. We're back on track. Maybe the one regret I had was I closed out these SPX spreads, because for those of you who were watching the market on Friday, it was a crazy day. You can see right here we finished plus 2.36%. Pull up the SPY. Let me type it in here. There we go, and we can pull up the maybe 5 day to show you guys what's going on in here. Yeah, we opened up a little bit. I mean, I guess we could tell the whole story from pre-market too. This is basically when I woke up that morning. We were down decently from the night before. Inflation numbers came in, we spiked up, the market opened, we spiked back down. The spread that we had open basically needed SPY to finish roughly above this level right here in order to get max profit. Anything below this would have been max loss. So we figured right after the market opened and there was this big red candle, probably just safer to, spare ourselves some potential loss right there, because we had enough bullish positions in play to benefit off the run at the end of the day. But we would have made a couple thousand more, but one of those moves that I think objectively was the smart move. So I'm not too upset about that. Definitely a bummer to look back at. Regret closing it, knowing what we know now. But that's just kind of hindsight eating away at us, as opposed to us having made a stupid decision. But all in all, everything that we were holding on to totaled up for a nice little 1% return. That's what we go for every week. Obviously, we're going to need a little bit steeper than 1% a week to get back what we we're losing so far in January. But again, with the positions that we have in play right here, I'll quickly run through why I think that's not too big of an ask at all, right? So we've been rolling these Palantir 13.5 strike puts. Those last week lost us a little bit of money. They lost us $620. The big issue with that one, right, is we had these shares at one point back, the 24th step of this ongoing trade was that we took even more shares. We had 2,000 shares at one point, and eventually we said, you know what, it's down to 13.8. I think there could potentially be a little bit of further downside from here, so let's just dump the shares. Let's start over with an objectively smarter trade. So what we did last week was we just got rid of the shares for 13.8, and we sold 13.5 strike puts for 53 cents a piece. Now, these lost us $660, but I think the value here in reviewing what we did is the fact that, yes, we lost $660 by rolling the entire position down to 13.5 strike puts. However, if we had held on to the shares, the stock dropped from 13.8 to 12.71, so we would have lost about $2,200 if we had kept holding on to those shares. So in rolling down and getting into a safer trade, we actually saved ourselves about $1,500 right there. So while it still was a loss, I like to see that avoided, potentially larger loss, as a little bit of a gain, as a little bit of a win on that trade. And again, we have all the time in the world to make this back, right? And even though those lost us $660 last week, we rolled to the same strike for a credit for the upcoming week. If Palantir recovers, gets back up to 13.5, these are going to expire worthless. That's going to get us $2,200. And the process is going to carry on. And I think I need to pull the formula down so it adds both of these up. But again, the idea, right, is we're in a pretty big hole. We started playing Palantir back in November when I was at 24.8, and it's essentially dropped 50% on us in just about 2 months. And that is a very unusual, catastrophic type drop. But the point is, right, we could keep selling these week after week after week, and maybe it's $1,000 we get back. Maybe it's $2,000 this upcoming week if Palantir gets back up to 13.5. But, the point here is that we're not going to try to get this all back in 1 week. It took 2 months of a very, very big drop to dig us into this hole, but we don't want to make the hole any bigger. I think a lot of the issues sometimes that we fall into with this strategy potentially is the sunk cost fallacy, and us continuing to sit on these shares, without selling covered calls, without benefiting from a little bit of option premium, I think would have been us falling into that sunk cost fallacy. So let me actually update this formula right here to pull down to that row. And there you have it, right? So if this gets back up to 13.5, we'll be sitting on an $11,000 loss. Then we can do the whole thing again next week. And it's one of those things where, yes, this thing has dropped a ridiculous amount on us, right? But, these trades, we can just keep entering them week after week after week after week. And it's only January. Sometimes we have to stay in these trades for a little bit longer than a couple months. And I think the example I always like to pull up, here we go, is GHIV. When we were in this thing from December 9th of 2020, and we finally exited last summer on it. But it had all these different legs, 29 different legs, and then got us to an $11,000 profit. And this is despite a 12% decrease. So obviously a far less severe decrease on the stock. But this thing had been all over the place, and it was one of those things where it eventually rebounded up to this 12.36% number. So there's no reason that Palantir, a few months from now can't be back up at 15, 16 a share, and we've been benefiting, getting $1,000 here and there every single step of the way, and be back even on this one by summertime. And speaking of other longer term trades that we've been on, that we're looking to break even on, Draftkings is a great example of one that's actually been going, as poorly as it's gone. It's actually been going okay for us. And we'll touch on Affirm and Roblox in a second because those are important ones that we definitely want to dedicate a little bit of time to talking about how we're going to manage those. But let's take a look at Draftkings up next, which actually made us some decent money last week individually because the stock went back up above 20 a share. But again, here is what's, starting to also become a similarly lengthy trade history. And, where I really want to draw the attention on this to demonstrate what we've been doing is over here on the break-even price tracker, right? We started playing this one at the end of November when the stock was trading at $36 a share. And as of today, our break-even price is $25.26. And, obviously we sold the 22.5 strike call, so we're not going to be able to to dump our 22.5 strike calls. Or excuse me, we're not going to be able to dump our shares for 25, 26 because they're capped at 22.5. But, this is an example of how we just walk this thing down week by week by week by week. We had a stock drop 42% on us. That's an enormous drop in just, 2 months' time again. And despite all that, we still have a break-even price that we conceivably could get to in the next couple weeks. And Mark G is letting us know in the YouTube chat that he's got more rows on his spreadsheet. We have unlimited rows on the spreadsheet, which is, maybe fitting because we have an unlimited amount of time to get back in the game on a lot of these trades. And quite frankly, these are on stocks that we're comfortable with playing at these prices, right? Draftkings and Palantir, Palantir was maybe a little bit inflated, but felt like we were getting in at a good level after it had dropped from 38 to 24. But, good lesson that things can always get worse for us. But now with Palantir in the low teens, now with Draftkings around 20 a share, Draftkings was just issued a analyst price target of 30 a share. So there's no reason we can't play this thing back up to that 30-ish level. But again, the point I want to illustrate here is that we've been walking this down bit by bit by bit by bit. At one point, at the lowest, we could actually pull up the Draftkings chart because just last week, it was actually earlier this week. 1741 is where Draftkings bottomed out at, which is an insane drop, right? Because a 180-day chart, which those of us who have been playing this stock probably know super well at this point because it peaked at 64 just back in September of last year. That's 4 months ago. This thing was trading over 3x the current price, and all we need, is a bump right back up to this level to break even, despite what has kind of been a little bit of a disaster that we've been following down the drain on this one. However, again, theme remains the same. Everything is going to be okay, and here is how that is going to play out. So right now, we mentioned that we sold 22.5 strike calls, and our break even's at 25, 26. So this week, we won't be able to break even. But the idea is, look, this stock is trading for 2064. We sold 22.5 strike calls, meaning that, roughly $2 out of the money, we're able to get 40-ish cents of premium, which means that we could decrease our break even by 40 cents a week, roughly, which is pretty solid, right? Because we have theoretically unlimited weeks that we can go forth and do this. Now, if DraftKings goes back up to 22.5 this next week, here you go, right? That changes the stock price up here. We're now only sitting on a $5,000 loss as opposed to a $9,000 loss. And again, this is the next step close to breaking even, right? Even though the stock has dropped 37.5% on us, we are now in a situation where we noticed that this week we could sell $2 out of the money for 40 cents. Conceivably, the following week, we'd also be able to sell something like a 25 strike call for 40 cents, which would get the break even down to 24.8. And while we can't break even this week, if we get into this hypothetical situation, for us that means we'd be able to potentially break even next week despite riding a stock on the way down that has decreased this amount on us. And this is how we weather the storm, ride the waves of what has been, quite frankly, a really, really big sell-off in the market, despite what a lot of the S&P 500s and NASDAQs of the world look like, because those are a little bit propped up right now by the larger cap stocks. So I think the real damage in the market, really, looking at those indices doesn't tell the entire story. So the fact that we're kind of riding the waves on trades like this, with confidence that eventually the market will either flatten out a little bit and we could just keep knocking 30, 40 cents off this a week, in which case 10 weeks from now, which would be a couple months, which would be, March, April-ish, we'd have a break-even price around 20 a share. And again, theoretically, we could do this for the rest of the year and have a break-even price below zero at some point if we have to stay in it long enough. But, I think this DraftKings one has been a really good example of not falling into the sunk cost fallacy. Sometimes we have to sell calls below our break-even price, but in doing so, we accomplish our number one goal, which is lowering that break-even price week after week after week. But if DraftKings runs back up to 24, that sucks because we lose $1.50 of potential profit on the shares. But again, the shares are a little bit elevated. We could jump back in with some cash secured puts and keep chipping away at this number right here. So, pretty confident in this one despite the poor performance so far. But, again, nothing that I think we can't save ourselves on. I think, honestly, Palantir is the most quote-unquote gone trade so far, and that's why I rolled that thing down to 13.5 strike puts as opposed to trying to get it all back. But Draftkings is, sharply fallen, but still hung relatively in the area we need it to in order to keep collecting premium around strikes that, we'd be comfortable dumping the shares at. So that's the plan with that one. Draftkings, we're going to keep doing that week after week after week after week, right? And we could play the hypothetical game looking at what we have set up for the upcoming week. How would our P&L for the upcoming week look if, these stocks just stayed entirely flat, right? And if DraftKings stayed flat, nothing would happen to the shares. We'd get max profit on the calls we sold. Fubo, nothing would happen to the shares. Max profit on the calls, but again, BKKT, I think that's trading at like 360-ish, so that'd be worth 0.4. But Beyond would be worthless, SoFi worthless, Robinhood worthless. And all of a sudden, we start to put these trades together, a bunch of little base hits. These premiums right here are guaranteed because they're covered calls. And the only downside is that, we'd have to dump this at 22.5. But if that did get up to 22.5, there you go. We've got $3,700 back right there. And that's a 4.7% return for us just with those alone on the week, right? Don't even get me started if things like Affirm or Roblox turned around, and this goes down to 7, and this maybe goes up or goes down to, 15-ish. All of a sudden, this is where our money starts to flow back in. And if we go to the year-to-date summary, even though we lost $38K in January, even just a little week like this where the DraftKings gets called away at the strike that we sold and Affirm and Roblox give us a little bit of cash, that's a 7.34% return. So while we're definitely underperforming the S&P 500 on the way down, the way that we've set ourselves up to recover some of this money on the way back up is what is going to get us back in the game. And if we really want to keep playing the crazy hypothetical game here, right? If Affirm is trading above 55 right now. It finished at 59.71 last Friday after jumping back up 17%, which was so helpful for us. But again, if that finishes where it's at, these are going to be worthless. We're going to make $12,000 back right there. Roblox is trading at, I think, 59-ish. Where did Roblox finish? 58. Bummer. All right. So those would be worth, a 70 strike put would be worth about 12 a piece if that expired where it currently is at, which would get us down to a decent number here. But again, there's $20,000 of extrinsic value on the table between Affirm and Roblox. And a lot of the losses that we've had week after week after week, right, have been these Roblox right there. We lost 3,400 off the bat. Roblox, we lost another 13 while we lost 2,200 off Affirm. Roblox and Affirm, we lost, 8,000 right there, right? But, the transparency is important because this is all part of the process, right? But a lot of these losses that we've had along the way here are really unrealized losses thanks to these two trades right here. So if they turn out okay, we're going to be looking at a very, very decent position. And if this goes back down to 0 and Roblox recovers up to 70, don't even get me started. We're break even on the year despite how terribly things have gone so far. And that Roblox spike back up to 70 potentially if you look at their chart. We just needed to get back up here. And looking at where this thing historically has traded for the past, 180 days, that doesn't seem like too big of an ask to, have a little bit of a rebound, fill this gap up to the mid 60, low 70 area and bounce around here. One of our big theses when we entered into this trade was that we saw a lot of support and resistance between, the 70 and really the 90 level here. So we figured if it did break down below 90, it would at least bounce around a little bit as it historically did. But kind of insane. It broke down some really, really big red candles after we got into this and really hasn't seen a lot of relief. So terrible performance from the stock so far. But, that happens sometimes. The good news is that this trade has a longer time frame. It expires in April. The cushion's pretty much gone, so to speak. But we are in a position where we will be able to potentially roll these trades even if they don't turn out the way that we want. So what do I mean by that? This is a very, very important point that I wanted to talk about on the stream this week is how are we going to manage specifically Roblox, since that's the one that's a little bit deeper in the money right now, and how are we going to handle that if we get to expiry and the thing is still trading at about $58 a share. So let's go over to that Roblox trade breakout tab, and there you can see it, right? $12,000 of loss so far on Roblox. That is an enormous number, but as we demonstrated, right, these are really all unrealized losses. So if this thing bounces back up to 70, all of a sudden we've made 5,700 bucks on it, and that has really done a great job in turning around what has been a rough start to the year, but nothing that we can't recover. And let's talk about how we are going to recover that, right? So let's say today's April 14th. Our Roblox 70 strike puts are set to expire, and it's trading at 58.18, say the same exact price. So we know that once the extrinsic value on this thing is knocked off, it'd be worth 11.82. We're sitting on this kind of a loss so far. What do we do now? And the answer is we are going to roll for a credit. And what do we know about rolling for a credit? If we're able to roll down and out for a credit, we do that. However, with Roblox, maybe you want to get a little bit aggressive and play the 70 strike again. So April is roughly, how many months away? February, March, three-ish, 2.5 months away. So what we want to get an idea of is what does the premium at the 70 strike look like 2 months out, right? So let's assume we wanted to roll these to April, May, June, or July or something, so 2 months further out. To get an idea of what that would look like, we look at the option chain right now, and we go, okay, what's 2 months from now? It's March. And if we look at the 70 strike puts, those things are going for about $16-ish a piece, right? So what we would do, we buy to close for 11.82. We would sell new ones. So these would be, hypothetical June 70p, which would be 2 months out from this hypothetical April date that we're looking at. And we know that those typically 2 months out, 47, we could do more than that, 74 days out, they're going for $17-ish a piece. So, okay, let's look at that and let's plug that in. That would be a $17 credit to open right here. And our debit to close would be this formula of max 70 minus the stock price and then 0, which knocks that extrinsic value out, which would be worth 11.82 again. So if we copy this formula down, we find ourselves in a situation where now if Roblox is at 58.18, come June, we have recovered $7,700 because that extrinsic value has decayed. And then what this also does for us is lower our break-even price by the credit. So we know the credit is the difference between the debit that we closed the original options for and the credit to sell the new ones for. So 17 minus 11.82 is going to equal 5.18. And that 5.18 is going to be a direct reduction of our break-even price. So our break-even price heading into June is going to go down to 61.02. And I think if we plug this in, the numbers should work. Please work, please work, please work. Something's wrong right there. It's because I did not update this formula right here. This needs to be pasted as a value. And now if I put in 61.02, there you go. That is how the numbers work together to get us back to break even, right? So remember that if you don't change the strike, the credit you roll for is the direct reduction to the break even price. And then now we find ourselves in a situation where come April, we roll these things, and we now have Roblox essentially at a 61 break even price, even though we started this trade in January with Roblox at 95. So we have enough cushion to protect ourselves from a 35% drop over a 6-month period. And now, yes, it has dropped more than that at this current date. However, it could also bounce back up to 70. This expires for max profit, and we never even have to worry about this second leg right here. But this is the idea. And if you want to get even more defensive, because if this goes back up to 70, you still leave yourself some upside here, and this trade can make you $13,000 overall, because the other thing that we know about the credit is not only does it decrease our break-even price, but it also increases the potential max profit on the trade. So we go from potentially having only made $5,700 on the first leg to making even more thanks to this credit we rolled for. And potentially, if Roblox is above 70 come June, we have a trade that has gone from being a disaster as it currently stands, because these things are worth like 17 right now, and we've lost like 20K on them. We've gone from that to a trade that has made us 5 figures just as long as Roblox, gets back to the 70 level, or even can just go back up to the 61-ish level, and we're at break even, and then we could do the same thing for the upcoming month. And if you wanted to get a little bit more defensive, right, you might say, hey, HT, don't you normally recommend rolling down and then out? The answer is absolutely, right? We just want to make sure that we do so for a credit. So if we close these out for 11.82, where can we get 11.82? The answer is the 65p right there for about 1360. You could accept a slight loss by going with the 60s right here and having a lower target to hit. But I like the idea of the 65p right there if you wanted to roll down and out. And let's plug that in there and finish out the thought. So the 65 strike put for 1360 of credit. 65 strike put for, we said, 1360. Formula on this thing would change to 65. And there you go. Now your break-even price is decreased by the credit of 178 and the $5 decrease in the strike. So this gives you a larger decrease in break-even price, 678 as opposed to 518. So you get yourself another $1.60-ish, right? So it would actually be 66.2 minus 678 to get you to a 59.42. Hopefully the numbers work out again for us right here. There you go. So that would get you to a 59.42 break-even price if you wanted to take the slightly more conservative route and go with the 65 strike put. And again, that still leaves you some decent upside for a bounce just back up to 65, where you're still taking home $8,000 over a 6-month period, which is never too bad, especially on a trade that has done this to us. But that's kind of the situation we're in right now, right? Definitely tough to be sitting on April cash secured puts that have dropped so sharply on us in the first month of the trade. That obviously was not part of the plan. But this right here, what we've outlined and how manageable this break-even price is if you want to keep rolling on a 2 or 3 month basis. Excuse me. That is why I like these, just a couple of these longer term cash secured put trades. And because despite the big correction that we've seen so far in the month of January, and with these stocks being hit particularly hard, right? If we go back to that Roblox chart, this is essentially the time frame we've been playing it in, as it goes from 90 to 53 at the low point. But this is why we like that, right? Because we take advantage of the volatility. If we were playing this on a week-to-week basis, we would be getting absolutely crushed right now by the sharp weekly drops. But we know our break-even price. We know our expiry, which is going to come up in April. So we're going to sit back. We just let the chips fall as they may. And this is our contingency plan about how we are going to potentially manage that by rolling those puts, another 2 or 3 months out into the future to make sure we get some sort of a credit, which could conceivably get that break-even price down below 60 a share. And if you pop back out to the 1-year chart, this thing IPO'd back in March of last year. A break-even price of 59 is right around here, basically the low price that anyone on planet Earth would have Roblox at. So, that is the value prop right there, especially when we jumped in on 90. Now, I think this also lends itself to a little bit of a conversation about what we could have potentially done differently here to avoid getting ourselves in such a big hole right now. Because again, as we mentioned with those Affirm and the Roblox trades, the 2 longer-term cash-secured put trades that we're in, those are responsible for a huge chunk of the loss that we are sitting on right now for the year overall. So what could we have done differently? And I think, issue number 1 is the position sizing that we had on both of these, right? So if we go here, this is fully cash secured. Roblox is 70-ish% of our account. Now, we liked that because off the bat, you could divide that by 10 and the trade only took $10,000 of margin. But as the trade has dropped, you can see in the formula here, the margin is now 33% requirement as opposed to 10%. So it's taking up a little bit more of our actual buying power as well right now. So obviously off the bat, I think we should have stuck to those principles that we lay out for our more weekly HT wheel type trades where we want to start a little bit smaller. I'd maybe cut the position size in half because we sold these things initially, right? The Roblox 70 strike put specifically. Let me go back to the tab. We sold these for $380 and they're up at like 17-ish right now, which is just absolutely insane, right? Even if we just did half of a position and then now that they're trading at, 17 right now, entered into the other half, that would get our average credit up to $10 for those cash secured puts. And then that would put our break-even price at 60 right now, as opposed to having to wait until April to get it up to 60, or get it down to 60 rather. So I think that is probably the bigger takeaway. I do love the idea, right, the way that the trade set up with the small margin requirement and the huge cushion, right? Because we were entering into these 70 strike puts with Roblox trading at 90. This is basically the chart that we were looking at when we entered into the trade and said, okay, RSI is getting pretty sold off. some big red candles. We're approaching an area where, we're probably going to see a little bit of or support. There's a lot of different areas of support on the way down. But again, always important to know that even if you have the best trade plan in the world, markets can defy the way they've historically traded. Things can defy logic, and you could find yourself in this situation very, very quickly. The important part is just that you have a plan to get yourself out of that situation. And we have outlined that plan for ourselves. So again, if we could change one thing, I think it would be to start with just half as much of a position, right? Because, a firm's looking okay still. It's above 55 a share. Roblox is deeper in the money. But, we've got plans. Things are going to be okay. And while we maybe only would have made half of the 5,700, we would have made like 2,800 or something like that. If we cut the position size in half, that's still not too bad of a return over a couple weeks or a couple months rather, especially with that smaller position size in mind. So that is what we're looking at with that. That's kind of the lesson I think we may consider learned on the way that these have gone for us so far. But again, super optimistic about how we can roll these things, how we can manage those break-even prices. And again, at the end of the day, we could keep doing these forever. And if these eventually get back to even, we are basically ourselves back to even on the year, despite the fact that the S&P 500 still has a little bit of ways to go, right? It's down 6.95% on the year so far. And that's definitely not something that is going to be recovered in, 1, 2, 3 weeks. I think if we look back at 2021 for how the S&P 500 performed, what tab do I want to look at? This one right here. The best week or the best month in the market last year was a 5.76% return, which would not get the S&P 500 back even. So even if we had the best month possible, or even if we had an equivalent month return-wise as the best month from 2021, the S&P 500, that would still not get us back to break even. So it's a long way back. We're going to have to take it week by week by week, but I'm not worried about the S&P 500 suddenly getting back to break even, and then we're still kind of getting hung out on a ledge on these trades. It's hopefully going to be a slower, steadier climb back to all-time highs at some point in the future, right? Whether that's a month from now, whether that's a year from now, whether that's 5 years from now. The trading style that we're using, the tools that we have to lower that break-even price on a continuous basis, I think we're well equipped to manage any sort of further volatility in the market. And can things get worse from here? Absolutely, right? Because these are some in-the-money trades. If Roblox goes to 45 and this thing is worth 25 at expiry, we're going to lose another $12,000. That sucks, don't get me wrong. But again, we can just keep following the same process, knock a few bucks off the break-even price. And, if we have to take a decent loss on a trade, we take a decent loss on a trade. Because if this thing stays above 55, hypothetically, that completely knocks it out. So, I don't hate where we're sitting at right now as far as these two trades are concerned. Just the lesson to reiterate once again, because I think it's super important to talk about, is the fact that we're maybe going to start smaller and maybe have a third, right? Because we have a little bit of diversity between Affirm and Roblox in the sense that they're two different companies. But, it does help us out that we didn't just go all in on Roblox or all in on Affirm, because we've got one that's working, one that's not working right now. And maybe if we cut these position sizes down a little bit and open 3 or 4 of these at once, we'd still be able to get that max profit target that we were looking at, which is why we went with the larger position in the first place. And we'd have the benefit of having a few more tickers in play that we potentially could benefit from, and kind of mitigate any sort of risks associated with the big drop in a couple names. So that's what we got right there. Fubo, same kind of story. We're knocking that break-even price week after week after week. We can go to the trade breakout tab there. We've got it down to 1281, which is, not incredible. But we sold 11 strike calls. That's just kind of the way it goes when after 6 weeks something has dropped 35% on you. But this is one we've talked about super, super in-depth in the Discord as well, and the fact that we're happy with Fubo. There's a decent, if we pull up the Fubo chart here, I think there's decent support in this $8-ish level. So I can't really foresee, if you go back to that 3-year chart, there we go. 812 is the low on the stock. And as demonstrated a little bit, some decent support at this $9 level. And we already bounced off that pretty sharply last week. So happy to hold at this level. They're increasing their streaming rights. I think they, ahead of earnings, announced that they were raising guidance on expected subscribers So it seems that the business objectively is doing pretty solidly, and they have rights to stream the World Cup this summer. One of those things where I think the ongoing buzz is enough to carry this thing back up to the range we need it. Right? We don't need a huge rebound of 100% to get us back above 17.5. We really just need a little bump back up to the 1281 level. And if we go to the 180-day chart, we throw that $12, an 81-cent break even on there. If this thing moves with me. There you go. That is our break-even price. Let's take this one off, remove the old drawing. So yeah, so it's not a huge ask to see a little bit of a swing right here. We've got a couple gaps that we potentially can fill right there. But, another one where I'm happy with the stock. IV is high. We're going to take advantage of that, absolutely. And we're going to let the numbers work themselves out. It's not going to be next week. It might not be the week after that, but we might find ourselves in a situation a couple weeks from now where we can start selling 13 strike calls and getting a little bit of premium. It doesn't look like they have earnings on the horizon. But, if we go, let me see if I could find where they might be. Not really sure, but even if we wanted to go out to March or something, right, we could get, if we wanted to be super, super conservative, go out to March, we today could sell 13 strike calls for 70 cents, get that break-even price down to 12, and leave ourselves with a situation where we could make, $2,000 on the trade and just set it and forget it. However, I'm always a believer that, especially when IV is as high as it is right now, definitely partial to the week-to-week premiums that we could pick up, right? Because we're able to sell these things for like 20 cents a piece at 11 strike, and that's an over 10% increase for the upcoming week if those were to be hit. And then again, same logic that we're following with the Draftkings position. If it gets back up to 11, we'll roll those strikes even higher, and presumably we'll be able to get 20 cents on like a 13 strike or something like that. But even if you wanted to go hands off and go out to February 18th, you can get 21 cents of premium on the 13 strike call. But again, you lose a little bit of that flexibility on a week-to-week basis, and I think that is super, super valuable. If you wanted to get back in on a strangle, right, we've already seen some decent support demonstrated at that 9 strike, but there isn't a ton of premium on those right now. You could get a 1% ROR, right? That's what we like to look for, 1% ROR on just the 8 strike puts. That's pretty solid right there, and I think we could pull up our little cheat sheet and start filling this thing out, because I know I said I wouldn't spend too much time doing the recap, but I think there were definitely a lot of important things to hit on. But that right there, that 1% ROR, decently out of the money. Fubo, 2-4, 8 strike put, really, really solid right there. And I think, what was that number again? 1.59% ROR. So that is a decent one, right? And I think the general idea is, what should I jump into? I think the answer is anything that we are in right now is, the best thing that we could suggest, right? Because we're kind of putting our money where our mouth is, so to speak. So anything like Fubo, BKKT, I'm kind of on. I'm giving that one more week to see if we can get a little bit of a bounce above 4, and then try to claw back some of this loss that we had after we started playing it at 825, and it just fell 56% on us. So, that one, a little bit TBD. We'll see how this one ends up, right? If it gets back to just 4 this week, we've knocked we've got a little bit of money back, but at the same time, still a decent loss that we'd have to recover. I think we'd be floating around like a 550-ish break-even price if we took those shares, but we'll see on that one. Definitely a little TBD on BKKT. Not a stock that I'm in love with, but the numbers are still okay to play it on a week-to-week basis. Robinhood was one we got in, I guess going from bottom to top here, a little bit reverse order, but Robinhood was one we got in post-earnings when they had a big drop right there on Friday morning. We could pull that chart up really quickly. And it bounced of 977 at the bottom and really, really, really ripped to finish at 1255. So after a bad earnings report where there was this big red candle, 24 hours later, the stock was trading, 10% higher than it closed the day before. And that is why, I love these option selling strategies so much, because let's say you sold an 11 strike put that was going to expire this Friday, and all of a sudden you wake up Friday morning, you're like, oh crap, what do I do? The answer is always just sit back, take assignment of the shares, sell the call premium for next week, and just sit back and wait. And the great part about that is if you were buying puts or if you were buying calls, there's a huge area of uncertainty during this little open period on Friday morning where obviously no one on planet Earth knows what the stock is going to do. You become an emotional trader. You start making decisions that are very, very impulsive, and impulsive emotional decisions lead to you making money. So the great part about that option selling strategy, right, is if you were in on 10 or 9 strike puts or something like that, you could sit back, objectively take a breath and say, okay, the stock has moved against me. However, here's the great news. I have the luxury of being able to wait all day, because when I signed up and sold sold the puts that I sold, I was okay with getting the shares at 10. So let's sit back and see what happens. Then if you sat back and watched what happened, the puts you sold would have expired worthless for some decent premiums. But with that, we were able to sell some decently out of the money 8-strike puts on on Friday morning. But I think a lot of the premium on these has unfortunately dried up. So that's that opportunity is a little bit gone. SoFi, I think similar story. A lot of these bounced, so the premiums aren't quite as good. Beyond is an interesting one as well, right? If we go to BYND, they're pricing in a massive, massive, massive move coming. Another one that spiked back up on the back end of Friday. So some of the entries aren't phenomenal, not as great as they looked on Friday when we jumped in, but that's kind of the value of those trade alerts that we offer on the Discord server. So you can kind of be plugged in about when we're entering into these things and kind of when the getting is good and when that premium is there in the market. But again, the thing was trading beyond specifically that we're looking at right here. It was trading at 64.55 back at the peak on Wednesday. So, even though it's rebounded, so to speak, to 56, that still is an objectively decent price you could potentially get in on. And if you look at the options for the upcoming week, you could get that 1% ROR down at 48, which is, kind of crazy, right? If we zoom this thing out, you basically set up a trade that says, hey, as long as we stay above this level right here, we're going to get our 1% return on the week. And as volatile as this thing was, I think the difference between the peak and the base here at 64 and 53 is $11. That's a very volatile week. If this thing has that same type of volatility and gets back down to 48, that'd be an $8 move, which is you are protected from. And again, we look at concepts like the expected move, which is $5.98. We could take a look at the market maker move, which historically has been pretty useful for trades like this of 308. Neither of those would get this even below 50 a share. So, even though you may not have been following along and jumped in on the 45s with us when we were able to get a decent amount of premium for those, I think the 48s are still a good option, giving us that 1.14% ROR. And in times like we have right now in the market with heightened volatility, what is rule number one for us? Rule number one is we always want to be able to protect our capital, live to trade tomorrow. And the best way that we could do that and protect ourselves against potential further drops in the market is to sell decently far out of the money, right? Giving yourself a 10% plus cushion for the upcoming week is a great way to do that. So if the market crashes again, not crashes, but continues to move further down, Beyond goes down 10% next week, guess what? You're still making money off of it. I'm always hesitant to go a little bit closer to the money in times like these because, you're a little bit more at risk, right? Because your break even on a 56 strike put at 250 of premium is going to be 53.50. However, you could put yourself in a position where you make money if it stays above, 48 as opposed to 53. So every bit of cushion you can get, and, we're afforded some really nice cushions with how volatility is in the market right now. So definitely take advantage of that. I can go on the cheat sheet, happy to throw in Beyond. Here we go. BYND 24. We'll go 48P, and those we're offering again a 1.14% ROR. ROR. And I accidentally hit caps lock, so we are going to delete that. I am all over the place on this keyboard right now. Good Lord. So there we go. We've got a couple of premium chasing trades in there. And if you want to look at something a little safer, right? We could go back to these trades that we've been playing with Draftkings, these trades we've been playing with Palantir, right? And even on Draftkings, 17.5, you could get that 1.04% ROR. I'd even be happy with an 18 because 18 minus that 0.24 of premium gets you like a 17.75 break even. That would stick you right here, which is, pretty solid. Super Bowl's coming up. The back end of the NFL playoffs are going on right now. I'm really, bullish on DraftKings in the near future, combined with this, pretty substantial sell-off that we've seen over the past 4 months. So I think, something's got to give at some point. There's probably going to be a decent little bit of a rebound. You could even look to maybe back in October, a good example of when it bounced from 46 to, 50-ish kind of out of nowhere. Or even from this period from June to July where it sold off from 55 to 42, which is, decent dip, but then steadily climbed over the next few months to get back up to 64. So definitely some precedent there for a little bit of a rebound. But again, take advantage of the fact that implied volatility is elevated on this stock. Go as far out of the money as you can while still getting that 1% ROR. And I like the 18 strike puts, so I'm going to throw those on the cheat sheet as well. And I turn these to be a little bit safer because I'm a little bit happier with Draftkings as a company as opposed to something like Fubo or Beyond. But we like these because we can go super far out of the money. But the 18 strike put, again, those expire on February 4th, and those are going to be offering us 1.35% ROR. So that's a solid one right there. If we go back to the profit tracker, what else do we have on tap for the upcoming week? Let's take a look at SoFi. I think we can get some good numbers on that one because, again, volatility is pretty high. It did bounce back up to 11. However, you could get in on the 9.5s right now even for 1.71%. That's going to be a little bit riskier of a trade, right? Because, we've seen some insane volatility here as it dropped from 24. I mean, this was on November 11th, and since then the price has basically been cut in half. We do want to remember that SoFi is a former SPAC, so this 10-ish level could be a little bit of a battleground. Whoever's selling 9.5 strike puts for the upcoming week still gets you a 1.71% ROR and sticks you below that $10 theoretical battleground price. Expected moves at $1.50, so that would stick you at, let's think 960-ish. That's still above that. MMM is 75 cents, which wouldn't even get you south of 10. So I like 9.5 strike puts on SoFi for a what we'll term a more premium chasing type trade, just because of that recent volatility. The company is not bad at all. 9.5 strike puts, and those are going to offer, what did we say? 1.71% ROR on the week for those. There we go. I managed to type that one in properly without messing it up. Anything on the little safer side? Maybe we could go take a look at Palantir, which we've been playing on a week-to-week basis. You could get 11 strike puts for 1.52%. That really isn't bad at all, right? 11.75 is the low on this thing. Volatility is sky high compared to where it has been historically. So 11.75 with the low and being able to sell 11 strike puts for 1.52% ROR. I mean, sign me up on that one, especially with where this thing's been trading historically. And this is a company that makes money. So again, another one of those things we go back to. I consider this to be, a safer trade because it's not some pre-revenue, electric vehicle company. But at the same time, they've got a pretty crazy multiple on them. But I like the way that the numbers stack up because, again, using this increase in volatility to give ourselves big cushions out of the money, selling 11 strike puts for 1.52%. So we'll throw that on there. 11p, 1.52% ROR. There you go. We're coming up on the hour mark on the stream, but we're going to keep this going. Let's try to get this thing decently filled out for the upcoming week, and let's also try to get the correct date in the top of it. There we go. So we've got some more trades we could potentially go. Let's go to the scanner. I think before we do that, one thing that I wanted to talk about, I wanted to make a point to talk about the roadblocks and the Affirm potential roles that we had to play defense on those. Another point that I wanted to talk about was a little bit about valuation. We had a question about if Robinhood would be a good potential acquisition target now that the stock has dropped so much. So if we take a look at Hood, let's get an idea of the price action over the past 180 days, right? They IPO'd at low 30s, which I still at that point that was pretty overvalued. I didn't really want to get in. Had a pretty crazy squeeze up to 85 a share and is now back down as we saw earlier at 12.55. So there has been a huge amount of value knocked off this thing just since it IPO'd last August. But let's get an idea of, even though it's trading at 12 right now, is that a decent valuation? And one idea or one good number that we want to have in our head is the market cap of the stock. Super easy way to find that is just type in Robinhood stock. And you can see that the market cap is $10 billion. So let's keep, all right, we could round that up to 11 billion. So let's keep that in mind. So we're going to want to go to the public filings, SEC, what am I looking for right here? Edgar. You go to company search page, and this is how you find filings for public companies. You're going to type in Hood, and we should be able to see their most recent earnings release. There you go right here, the 8K. We do not want the 8K. We want a 10Q. Interesting. Maybe this is in here. Let's see what they've got here. Why can we not see recent financials? Interesting. They only released Here we go. They've got some financials in here. Perfect. So this is for the year ended 10/31. Oh, so these were yearly results. It'd be a 10K. It wouldn't be a 10Q. But I do not know why they don't have a 10K filed, which is a little strange, but whatever. We got the numbers right here. So the first thing we want to look at is the balance sheet. We want to look at the income that they are making, right? Because one of the most common ways to value a company is basically by looking at their earnings. So if we go to net income or loss in 2021, and again, these numbers are in thousands, they lost $423 million over the last 12. Excuse me, that was over the last 3 months. Over the last 12 months, they've lost $3 billion. $3.6 billion. They are leaking money as opposed to having made $7 million in 2020. That is absolutely insane. You know, the idea is, where is this huge increase coming from, right? They've increased total revenues. It looks like it's gone up from 958 million to 1.8 billion, but some really, really big increases in expenses, right? 472% change year over year in technology and development. Another 3-digit increase down here in general and administrative, which is kind of a catch-all that I'd be interested to see if they discuss down here a little bit more in detail. This is a cash flow statement. It doesn't look like anything too in-depth, so that's kind of why I wanted to read the 10K if they had one available, but it doesn't look like they do. But from a high level, right, going back to the income statement, they're losing an insane amount of money. So you can't really value a company on a multiple based on earnings when their earnings are negative. So the question from there is, what can we value a company based off of? One other area is precedent transactions, but I don't know if there really have been any similar acquisitions to what a Robinhood acquisition would look like. So I think that's kind of out the window a little bit. And then, you know, in my experience, a lot of the valuations that I've seen for companies with negative earnings are just a basic multiple of revenues, right? You can acquire a company based on a revenue multiple. Now, these aren't nearly as high as earnings multiples, which can be between, 10x, 20x, and, in some cases you can see higher than 20x earnings. But, with what they're trading at, their market cap, $11 billion. If we divided, let me pull the calculator on screen really quick so you can see some very, very advanced math right here. Come on. If you take their $11 billion valuation and divide it by $1.8 billion of revenue, that basically means they're trading at 6x revenue, which is not something, that's not a multiple that you would typically see a company get acquired off of. It's still trading at a little bit rich of a valuation for me. So even though we have seen Robinhood drop all this way, it's still trading at 6x revenue. So just because it's down now doesn't mean that it's in a good place now for an acquisition. I just, unless a company had a really, really good plan for, integrating and having some sort of insane benefit from synergies that they could set up, I really don't see Robinhood as a potential acquisition target at this price yet, especially because they're just, they're leaking money, right? And even if you took out these big categories where they lost 1.3 billion and 1.2 billion, if you strip out this 2.5 billion of expenses, they're still not making money. They are still not making any money. So that is definitely a tough look for their financials. Things do not look fantastic. This isn't a company that I think would be primed for acquisition, at this current valuation. Now, if we get our hands on a 10K, we can get an idea of, these are, artificially high due to X, Y, and Z. These are artificially high. We project revenue out to this number. Maybe you could get a little bit more comfortable around that, but just based off the information that we have in front of us here, I wouldn't be terribly comfortable about it. People talk about the amount of cash they have on hand. It looks like they have $6 billion in cash. Is that different from restricted cash? It is different from restricted cash. I mean, they got a decent amount of cash on hand. So if you wanted to say, if their company were strictly based on cash, that'd probably be about half of their current price, right? 6.2 billion is roughly half of, 11 billion. So that would cut the price of the stock in half as well. But again, the reason you have all this cash is, I'm assuming, to service some sort of liabilities that you have, which you could find right here. And they have, roughly 12 billion in liabilities. And it looks like a lot of that is AP and accrued expenses. Wait, nope. A lot of it is payables to users. That's not great. That pretty much covers the entire cash balance right there and doesn't even begin to cover the securities that they've taken out. Just does not look like this company from a financial standpoint is in a great position. So from a valuation perspective, short answer, that is why I don't think Robinhood, at its current level is a very good acquisition target, despite the fact that it's run down so much. So I think those are kind of the two maybe extraneous items I wanted to cover on the stream, unless we wanted to talk about what we're betting on in the Niners, Rams, and the Chiefs, Bengals. I don't know if I have an answer for that, Mark G in the chat, or if Mahir's on, he might have a little bit better of an answer for us. But moving on, let's go to one of our scans real quick and see what's going on, because I think the next section on here are let's talk about earnings for the upcoming week. Earnings. And let me pull up the tab where we shared the image really quickly. Let me go into here, go to the earnings plays channel. And I thought we did share one. There we go. So here you go. We've got a lot of big names for earnings in the upcoming week. And again, when we sell earnings trades, I typically like to look at this Wednesday after close into Friday window. So play companies that are in this range right here. Just because obviously post earnings, you have this big implied volatility drop off. But again, if you're selling weeklies at the end of the week, you're also going to get this accelerated theta decay. And in addition to that, you're also going to have less time, really only a 2-day window for the stock to continue to move against you. So if you play stocks with earnings Wednesday after close and beyond, you essentially set yourself up with benefiting from the increased option premium as a result of the earnings induced implied volatility increases, and you really set yourself up with a very short time frame for things to go wrong. So that would put, Facebook, which is, I guess we're calling it Meta now, Qualcomm, Spotify, T-Mobile, Amazon, Nokia, Snapchat, Pinterest, Activision, these are the types of trades that could prove very, very profitable if you take a look at those. And we could start to take a look at some of these, right? Let's take a look at Nokia, because I know that one's a little bit less expensive than the, $3,000 a share Amazon. And okay, let's throw that one in there. What are they trading at? 572. All right, so decent floor right here at around 550-ish. I mean, this was one, I remember this one well because there was we played this spike. And it went okay. It didn't go as great as it looked like it may have at one point. But again, the volatility has definitely been there historically. So we definitely recognize Nokia. And I like to look at this 180-day picture. Bounced pretty hard off of this 530 level. Looks like last weekish, 24th. When was the 24th? Last Monday. There you go. But with earnings this upcoming week, let's get to the good stuff and look at where you could, conceivably get some option premium. And at that 550 level, you can get about 12 cents a premium. What do we know about that? We know that 5.5 minus 1 or 0.12 gets you a 538-ish break-even price, which is right around here, honestly. That kind of lines up with the bottom of this, lines up with the base that we see over here, lines up with, a little bit of the base that we see over here, and it bounced off that level back in September as well. So from a pure earnings perspective, I don't hate the 5.5 strike puts. Those look pretty solid. I'm going to throw those onto the cheat sheet. But again, definitely want the caveat of waiting until Wednesday afternoon to open these, right? Because we do like to target the ones at the end of the week because they give us a smaller time frame for things to move against us. But that's just because, in order to get that time frame, we have to wait until pretty much right up on the wire. So wait until Wednesday afternoon on these. But I do like the Nokia NOK 24 5.5 strike puts, which are offering 2.33% ROR. There you go. Let's take a look at a few others that we've got on here. We've got, Amazon we could take a look at, but that's really not going to be one we're selling cash secured puts on. So I think I'd kind of want to stay away from that. Meta, I think, is FB still the ticker from Meta? There you go. $16 $20 implied move right there. You can get 1% ROR at 280-ish, which is $20 below. This is pretty much right on the move. Don't know if I'm a fan of that kind of a cushion. 280 historically, obviously over the past 180 days, very, very nice. Be a very, very nice price to own the stock at. However, we've seen some similar tech earnings. I don't know. Microsoft finished up okay. Yeah, Microsoft is up above $300 a share after ticking down to almost, what did they tick down to? They had a pretty big red candle after they ticked down below 280, and just like that, they're back above $300 a share. So, I mean, unless you really are in love with the idea of investing in Facebook and holding on to those shares, which, personally I am not, I think I would tend to lean on staying away from this one because it really doesn't seem to me like, especially if we go to the Analyze tab, go to earnings. We've seen some pretty big moves, right? From 234 up to 253. Some decent gaps, 307 up to 329. 223 down to 209, which like an equivalent move would put you below that number. Just some decently large earnings moves. I'm just not convinced, selling 280 strike puts and having a 277 break-even price is going to save you in case, you potentially get back down to this 250 level after earnings. But again, if you are inclined to be a long-term investor in Facebook, then the 280 puts are a great option for you, right? Because those are offering the 1% that we like to look for. And that 280 basis is a very nice place to be over the last year on Facebook. And IV is very, very elevated right now. So not a bad idea, just if you want to be an investor. But I do not want to be a Facebook investor right now. Meta investor. So I will not be jumping in on that one. Let's get back to the graphic. What else we got? We got Spotify. They've got some issues right now with, artists taking music off their platform. Pretty big dip from 303 down to 172. There you go. Another example of a stock that, pretty much has had half of its value shaved off between the beginning of November and now. And do we even have any further history beyond this? There you go. It looks like this was kind of the big gap to fill this level from 220 down to 177. So it's there. It's filled the gap. And then maybe next stop down is 150-ish. I mean, is there premium around 150? There absolutely is premium around 150. Spotify premium around 150 right there. But another one where, do you really want to be invested in the company? If we go back to the chart, definitely some palpable downside to, 115-ish even, 130-ish. So I don't know. While 150 obviously over the last year or so is a fantastic place to be because it hasn't traded, below 150 since, let's go back here. In the last year, I mean, it's at a 1-year low right now. It hasn't traded below 150 since, May of 2020. So, a decent while back, right? We have to go 18 months back to find the last time it was this low. But again, one of those, I'm not terribly in love with the idea of being an investor in the stock itself. And that's always rule number one, right? You always want to sell cash secured puts on things you'd be comfortable with being assigned at that strike. So for Spotify, to go full Shark Tank on you guys, for that reason, I am out on Spotify. But again, if you like this setup, again, we don't always have to agree on our conclusion on if we like a stock or not. If you like Spotify as a stock, you think this is a great place to jump in. You notice that 3-year RSI is down below 30. You notice implied volatility is peaking to all-time highs. If this is something that you like, there you go. That 150 level looks fantastic objectively, right? With, above a 2% ROR at that level that lines up with a little bit of what we perceive to be support based on what we saw back in 2019 and the beginning of 2020 at these levels. So not a terrible one. I think that'd be one to just, be fun to keep an eye on, knowing what we know. And sometimes it works more often than it doesn't to just play the numbers and close your eyes and hope for the best. But at the end of the day, you can't wrap my head around taking assignment of that stock, especially when we're already in so many tech type names, and the valuations of a lot of those have been a little bit in question. So Qualcomm is another interesting one right here. I think it's QCOM is the ticker. Let's take a look, and this is the anti-Spotify chart, right? Over the past, let's zoom a little bit to a year, huge gap up between 137 and 154. That scares the hell out of me because if they have bad earnings, this thing drops into this gap, no telling where it potentially is going to end up. A $14 implied move gets you back down to that magical 150 level that is reared its head again. And that 150 level, you are in no man's land from this last earnings gap back on at the beginning of November. So that scares me a very, very good amount. If we go to this Analyze tab, and you can already see a little bit from the chart right here, right? They've had some pretty big earnings moves. If we go QCOM, right? Spiking from 138 to 150. 142 to 150 is not a big move. 162 to 147 is not that big, but 128 to 140, 93 to 107. There's definitely some precedent for some decent gaps on earnings. Don't know a ton about the company. I think they got a solid dividend. So, might be one where you say, hey, I want to collect a Qualcomm dividend. Let me get in on this. And now is a fantastic time to sell a put, pick your price, and do so before earnings. And I guarantee you this ROR for a 1 week basis is paying better than what a dividend would in case you were not assigned the stock. But again, not quite for me. There's so many different stocks out here, right? You could look at this graphic. So many different people reporting earnings in the upcoming week. If you're not entirely in love with the trade, there's no need to force yourself into one and say, the numbers look good enough, I might take a flyer on it. I think you really need to have some conviction in this type of a market about the trades, because if you don't have conviction on a trade, it is very easy to get shaken out of it if something goes against you. Snapchat and Pinterest, I think, are the last two I'll look at really quickly because, kind of interesting here because these things have been very, very beaten up. It jumped a little bit on Friday, but again, similar story on this 1 year chart to a lot of these different tech names and growth names that we've looked at historically, right? And this is, kind of furthers the point that we were trying to make a little bit earlier, that the stock market has not been in a good place over the past year. Things like Apple, things like Microsoft have kind of held their ground where they're at through this correction, which hasn't made the S&P 500 look as bad as it should. But I think if you had some sort of indicator for how stocks across the board, regardless of whether or not they're included in like the NASDAQ or the S&P 500 index, stocks are not doing well. But again, that provides us with some fantastic opportunities, some fantastic implied volatility, right? The IV rank is 95, which is crazy, right? The IV percentile is 99, meaning 249 days out of the last 252 days, IV was lower. And those 3 days are from last week. So if we take a look, let's maybe zoom out a little bit at the 3 year, right? Because we can't get an idea of where support might potentially be. And there you have it. This is very, very similar to a lot of the charts that we've been looking at, right? People get enamored with the stock because they look at it and it looks like this and say, okay, this is like incredible, This thing's run from 6 to 83 and don't really think about the implications of something like that, because more often than not, reality is going to show up. Valuations are going to, become reality, and you are going to see action like this. This is all too common, why we don't chase this kind of a setup when we see it, because this happens so often. And our option selling strategy cannot handle this kind of a red candle. It just cannot. And honestly, I don't think there are a lot of strategies out there that can handle this kind of a candle against you. But getting an idea, it looks like we've filled the gap on this big green candle from back in October of 2020, which the bottom of it looks like it was 27.91, and then maybe next support level is 21-ish. So between 27 and 21, there's a decent gap. But look at this. You can find some serious premium very far out of the money on Snapchat, right? You could get 1% ROR on a 20 strike put, which is, that's insane. You get 33% of downside protection in the next week and get that 1% ROR that, we like to look for so often. And if you get assigned at 21, probably not the worst place in the world to own this stock. I am not the biggest fan of Snapchat, the company, but sometimes you've got to be a fan of the way that the numbers set themselves up. So I've definitely got my eyes on this 20 strike put right here for 1.19% ROR. And if Snapchat dips further next week, we get a better entry, we might be able to get down and get, it's kind of funny looking at 5 or 6 cents of premium at a 15 strike, but even a 0.5% ROR, if this ticks up another few cents, is not a bad value proposition for a strike that gives you 50% downside cushion from the current price. And this is why we love high implied volatility environments. This is why we like earnings setups like this, where you could go super far out of the money and still get a decent bit of value on what you're selling. So I'm going to throw this tentatively on the earnings trade, right? Snap. Let me caps lock that really quick. 2.4, 20p. Those are offering, what are we looking at right now? 1.19% ROR. And those earnings are going to be Thursday, after close. So we're going to want to wait until Thursday afternoon to sell those cash secured puts. And, it sucks that the market has been volatile, and, volatile is usually just, synonymous with going down. But one thing, if you take away anything and add anything at all to your trade plan for the upcoming week, do not jump in all in on your positions Monday morning and load up from there. I mean, the way that this thing has been moving up and down and up and down and up and down, if there is not a good entry right now, historically looking at this past week, just wait an hour, because you will find some big red candles. There will be big green candles that might make entries worse off. And for that reason, right, we always want to have some trades in play. And if there are big green candles that make it so we don't get great entries into some other potential plays for the upcoming week, that's okay, because we have a lot of positions that are already, going for us, and those will benefit. And that's kind of the idea right there. If this thing will load and let me scroll to the bottom, there we go. Come on. Here we go, right? So even if it sucks and the market, okay, maybe sucks is the wrong word here, but even if the market shoots up and we don't get these entries that we've been looking at as we've looked at the option chain so far this afternoon, that's okay, because if the whole market shoots up, we are going to profit on these as well. So you want to keep a little bit of buying power, in your back pocket. We're at 78%, which is by far higher than I like to be. So I'm not going to be looking to be too aggressive with what we're doing. And a lot of this relates to these Affirm and Roblox trades, which are taking up 50,000 of, buying power. If we took these away, we're back down at 36%, which is a very, very sustainable number. However, we are not. So once we finally get these off the board, our buying power will look a little bit better. But again, we've talked about Affirm, we've talked about Roblox, we have plans for those. So I'm not terribly concerned that those are what are taking up a decent bit of our margin. But with that said, be patient with your entries, right? We have seen over the last 5 days, probably even over the last 10 days, if I pull a little bit longer chart in here, over the last 10 days, there are always going to be, maybe with the exception of this day right here on January 18th, but pretty much every single day we look at here, there have been a large, group of successive red candles. So if you don't like an entry right now, or you're like, I've got my eye on this strike, but, it isn't offering me quite as much premium as I normally would like, just wait a second, wait a few hours. The week is 5 days long. And as we have demonstrated ourselves, that is a lot of time in the market. 5 days is a long time. So be patient, pick your spots. And when you do pick your spots, try to go as far out of the money as you can, right? Take some of these strikes that are decently far out of the money and take advantage of this implied volatility, which is allowing us to still get those 1% ROR numbers on stocks that have some fantastic cushions. So we are hitting the 1 hour 15 mark. I'm probably going to cut the stream off right here. I think we had some good discussion about, hood valuation. We talked about what we're going to do with Roblox and why, even though it's moved so far against us, we're still optimistic about the way that position potentially will turn out for us. We've talked about what we're in for the upcoming week. We've talked about why Draftkings, even though we're sitting on a decent loss on paper right now, we like to consider this unrealized, because if we walk this thing back up to 25, all of a sudden we're back to break even, and why we think that is, a realistic goal for us to have. We talked about why we rolled Palantir back down to 13.5 strike puts, and why doing that last week actually saved us about $1,600, which, foregoing a loss is something I would consider a win. We looked at Beyond, we looked at SoFi. We threw a few things on the cheat sheet right here for the upcoming week. But again, we've got a lot of capital tied up in Affirm, a lot of capital tied up in Roblox, Palantir, Draftkings. So we don't really want to keep pushing, because I cannot stress enough, things can always get worse, right? We look at the last 20 days on the S&P 500. It's not great, right? We were back down at 420 just a week ago. The market can always get worse. And if we zoom out past just the 20-day and go to the 180-day, ton of volatility in here, absolutely. However, it wouldn't be too far-fetched to see things continue to move further down, because as we zoom this chart out, we go out to the 1 year, we go back out to the 3 year, right? This dip right here, as catastrophic as it may have seemed to a decent amount of people, it really is nothing, right? This is a COVID crash, and we have some of these highlighted, and we have a video on our YouTube channel talking about, how low can the S&P 500 potentially go, and we've drawn these red lines to illustrate, equivalent drops on a percentage basis. So if you are curious about what these lines mean and want to take a little bit closer of a look at these historic corrections that we've highlighted, definitely pop over to our YouTube channel, take a look at that, because I think we do a good job outlining how far we could potentially expect the S&P 500 to go if we had similar drops on a percentage basis as we previously have seen. So, that's kind of the big picture, right? Don't rush into your trades. Be patient. The market, this is one of the best markets to trade in because there are, for option sellers specifically, so much opportunity that we've already demonstrated with a lot of the options that we've looked at so far. And even more so, the fact that sometimes it can be frustrating to be looking at a trade and say, this isn't a great opportunity. The way the market's been lately, just hang tight, sit on your hands for 2-3 hours. I guarantee you one of these stocks you're looking at in one area will provide a better opportunity. And if it doesn't and the market just keeps ripping back up and we're at all-time highs in a month, we're going to be looking pretty good, because I can guarantee you if we're at all-time highs in in a few months from now, these are going to be worthless. This is going to have made it back to 25, which is where we need it to be. And all of a sudden, we're profitable on the year, despite being in a pretty big hole so far. But again, I think that transparency is so important, because this is the reality of trading, right? We did really well in 2021 if we look at that year-to-date summary tab that we have. We didn't lose money a single month in 2021, so we were due for it. But, all this to say that I think we have a solid process. We made a little bit of a mistake with the, position sizing on a firm and Roblox, and that's something we'll fine-tune in the strategy moving forward. But again, we've demonstrated why we don't think those are going to kill us, and why if we just have some slight recoveries across what we're holding, we could get back to this type of a performance, right? So the account at the beginning of last year was at 86K. Does it suck that we've dipped down a ton in January? Yes, but look, we're at 141 still. If you take a step back, look at our performance over the last 13 months even, we're still going to be okay. We've lost 38K on the year so far, but again, that transparency is important, because we're not going to sit here and just blow a bunch of sunshine up your ass about how it's so easy to make money every single month, because it is not easy to make money every single month in the market. And it is about time we had one of these months, and I'm very excited because in this month is the opportunity to show and demonstrate, why, even though this is a pretty catastrophic month for us, why what we're doing is going to lead us back, and why we are comfortable and confident that we are going to be able to make it back, right? S&P 500 dropped 6.95% this month. That is a pretty big number, right? If we go back to this 2021 tab, nothing really close to that happened in 2021. Very easy year. But again, even with that, right, we're 38K in the hole. If we just highlight, the first 4 months of last year, we made 40K. And that was with a smaller account balance. So the path to break even though it can seem very bleak right now, and things definitely look a little bit tough, it's never fun to look at your losses. Trust the process is what we like to say so often. And, the fact that we could highlight stretches of 1, 2, 3, 4, 5, 6, 7, or even the 4-month stretch right here, the stretch right here of 5 months where we have made cumulatively more than we have thrown away so far in January. So, we're not in it for 1 week. We're not in it for 1 day. We're not in it for 1 month or even 1 year. We have a long-term outlook on the market. Months like this are going to happen. And 1, 2, 3, 4, 5 years from now, we're going to look at this, laugh, love what we've learned from it, and it is going to make you a better trader. Sometimes the best lessons are the most expensive ones, but again, stick with it. Protect your buying power. Make sure you're not going to get margin called. And as long as you are good in that regard, everything is going to be okay. And as we try to, this is a point I don't think I've made on the stream yet, but definitely something I try to point out every single week as we work and, to get these Affirm and Roblox trades back even. We've been picking up some pennies along the way, right? We locked in 520 off the Fubo 9P, a little bit of cash on CLF and SoFi. We picked up some cash last week on these Peloton, Corsair, SPX spreads, Netflix. We picked up 2,500 there. Open, Wish, SoFi, Zynga, right? I feel like I've made the point. You picked up 2,200 there. And all these trades that we've locked in, right, on our 2022 trade performance, these trades that we've locked in as winners, they can't take that from us. We have locked that in. What we can do, though, is turn a lot of these losers back around and get them back to break even, and that is the plan. So when those get back to break even, we will see the cumulative effect of all of these other little trades that we've made along the way. And this week it's, Beyond, it's SoFi, it's Hood, and those right there are giving us $903 of profit. So, week by week by week by week. And even if we have just these small amounts each week, there's more than 37 weeks left in the year. Even just these alone will get us back to break even. So a lot of different paths back to break even. Tough market to trade in, absolutely. And for a lot of people who are newer to trading, it's probably the first decent correction that they've seen. So it can be tough to navigate that sometimes. But most importantly, don't do anything that is putting a significant portion of your account at risk of going to zero. Do not get margin called. Do not go full tilt, get emotional, start buying options. That is the worst thing that you can do in a high IV environment. So there you go. And as Holmes HC has pointed out in the Twitch chat, Warren Buffett overtook Mark Zuckerberg because Warren Buffett is sitting on cash. He's being patient. He has the long-term approach where so often a lot of these big gainers and a lot of the things you'll see on social media are based on people riding up these big tech bubbles that we're seeing across the board in the market. But again, we have an effective strategy because even when things like this do turn against us, when Draftkings has dropped from 36 to 20 on us, we are sitting 2 months later with a break-even price of 25, 26. It's a long-term approach to the market. I mean, no reason we couldn't have this thing under 20 bucks as far as a break-even price is concerned by the summer, because just in the 2 months we've been playing it, we've lowered it by 7. So if you extend that logic, in 2 months from now, it's $7 lower, right? We're playing DraftKings with a 18, 19-ish break-even price. So stick with it. Be patient. It's a marathon, not a sprint. You are only going to do yourself a disservice by treating it like a sprint and getting upset on a day-to-day or week-to-week basis in the market. Just be patient. But again, cannot empathize enough that it sucks to look at losing positions. But hopefully one day down the road, we'll be able to look back at this and say, remember how scared we were during this time, or remember how scared you were or I was, or things like that. But, nothing we haven't been through before. We can go all the way back to the 2020 tracker when we had a worse month. It was October, right? We lost $47,000 because our position sizing was terrible. We were in on a terrible stock with a terrible setup. And yet by year end, we had almost recovered all of that. So we've seen worse months, right? And we did this October month was a $47K loss on a like $110,000 account. So we basically lost half of our account in October of 2020. And we have still recovered from that. We got down to 62K at the worst of it. And it's never fun, right? This looks a lot like January. Week after week after week after week, it just gets lower and lower and lower. In the back of your head, there's always this voice saying, what if it keeps going? But at the end of the day, we got to trust the numbers, trust that investing is a long-term strategy. And eventually, as we saw by the end of 2020, it pulled back up to 89K. We carried that performance into 2021 as it went from 89 all the way up to 180 by the end of the year. And again, 2022 is not going to be without its fair share of speed bumps where we've been knocked back down to 140. But again, we're trusting the process that we've laid out, the process that we've proved, works over a long enough time frame. Because at the end of the day, even though we're selling options, we know that our recourse is taking assignment of shares. So at the end of the day, we're really just investing with some extra steps, right? And those extra steps are important because they can provide us with some really, really nice returns like what we saw in 2021. But at the same time, what we're doing is quite literally safer than buying stocks. So protect your buying power. Make sure you're not over leveraged and anything crazy, and everything in the long run is going to be okay. And that is going to be my spiel for the stream this week. So this is what we got set up. It was nice that we had a little bit of a turnaround and made some money in the market last week. Definitely a little bit of a breath of fresh air. But, that's not to ignore the fact that we've got a long way to go, but we have a plan laid out to get there, and we are going to execute it week by week by week, staying disciplined, staying on top of our trades and not getting too emotional, just following the processes that we have laid out. So for those of you who have made it to the end and have been sticking with us the entire time on this hour and a half stream, thank you so much. This has been the Hourglass Trader, where as time passes, we make money, and hopefully next time we see you, this number is a little bit smaller. So let's have a great week. Thanks again for those of you who are sticking with us in the Discord, on the stream. I appreciate it week in and week out. I love the community we've built. It's definitely made it easier, to stomach some of these losses. It's never fun to lose, but it's a little bit easier when you guys are all in it together. And I'm confident that one day, as I cannot repeat enough, we will be able to look back at this, with some lessons learned and some more money in our pockets. So until next week, thank you guys.